The broadcast is now starting. All attendees are in listen-only mode.
Good afternoon and welcome to AWCI's webinar focusing on the economy. I am Anne-Marie Salvatelli, AWCI's Director of Education, and I am joined by Courtney Kaplan, AWCI's Education Program Coordinator. Before we get started, we have a few housekeeping items. All attendees should be on mute during today's presentation. Should you have a question at any time during the broadcast, please submit it by using the question box in your GoToWebinar dashboard. We will have a Q&A at the end of our presentation, and we'll make every attempt to get all of your questions resolved. If you have any audio or visual issues during the presentation, please do not hesitate to let us know, again, by using the question chat function on your dashboard. Now I would like to introduce our presenter, Dr. Anirban Basu. Dr. Basu is Chairman and CEO of Sage Policy Group Incorporated, an economic and policy consulting firm headquartered in Baltimore, Maryland, with an office in Indonesia. The firm provides strategic analytical services to energy suppliers, law firms, medical systems, government agencies, and real estate developers, among others. In 2014, Maryland Governor Larry Hogan appointed him chair of the Maryland Economic Development Commission, and Dr. Basu also serves as the chairman of the Baltimore County Economic Advisory Committee. He is also the chief economist to the Associated Builders and Contractors and chief economic advisor to the Construction Financial Management Association. So with this, welcome Dr. Basu, and I turn it over to you.
Yes, Anne-Marie and Courtney, thank you so much for inviting me. Thank you, of course, the Association of the Wall and Ceiling Industry for having me today to talk about the economy and where we are in the business cycle and what 2022 and perhaps 2023 portends, either for contractors or for other economic actors. My presentation today is entitled No Time to Buy. This is a James Bond themed presentation. You'll see that theming throughout this presentation, whether you like it or not. I hope you don't hate it, but it is firmly baked within the cake. And of course, as had been noted, please use the features of this platform to ask questions, because I will leave some time at the end to address those questions. In fact, I've shortened my presentation today just a bit so that I could take or entertain more questions from you. So lots of places where we could begin such a discourse. I could, of course, start with Russia and Ukraine, the Russian assault on Ukrainian democracy. I could start with oil prices. I could start with the spread of Omicron in China, or in parts of Europe, or in Philadelphia, or in other places. But as it turns out, all of these things layer into something we've been talking about for quite some time, and that something is the specter of inflation. So let's talk about this, because this is the number one economic phenomenon on people's minds. And this, of course, has implications for the construction industry in many different ways that we'll talk about this afternoon. If you're, for instance, on the East Coast, it might be before noon someplace else. But in any case, let's talk about this. Now, you've probably seen some of the headline numbers. One of the most prominent measures of inflation is the Consumer Price Index, graphed here, back to the year 2000. Two lines here. The dark blue line represents the all items Consumer Price Index, total inflation, which over the past 12 months, between March of 2021 and March of 2022, my line got cut off here, but it's actually 8.5% is what inflation has been running at over the last 12 months. The lighter blue line is the all items less food and energy CPI, the so-called core CPI. So all the items except for food and energy prices, because A, those prices are volatile, and B, those prices are influenced by non-economic factors, often like weather, natural disaster, or Vladimir Putin, who is, as it turns out, a natural disaster. But the point is that inflation also running neatly above 6%, and that's at a 40-year high, overall inflation at a 40-year high. And so this has come as a surprise, I must tell you, to many folks, this bout of inflation. In fact, it's come as a surprise to people who should have known better, because they, in fact, control or exert some control over inflationary outcomes. I speak, of course, of the folks at our Federal Reserve Bank of the United States, our central bank, those folks who at their Federal Open Market Committee meetings establish interest rates, at least the short-term rates that they control, determine the size of the Federal Reserve's balance sheet. Here's some statements coming out of some recent FOMC meetings, those Federal Open Market Committee meetings. So back in June of 2021, the notion was, quote, inflation has risen, largely reflecting transitory factors. Hey, look, we at the Federal Reserve know there's this inflationary issue. It's June of 2021, we're coming out of this pandemic. There's some supply chain issues out there, but don't you worry, this inflation is going to go away. And not only will it go away, it's going to go away by itself. We at the Federal Reserve don't have to do anything about it. We don't have to raise interest rates. We don't have to shrink our balance sheet. Don't worry about it. Inflation is transitory. Now, in July, the statement was, quote, inflation has risen, largely reflecting transitory factors. Hey, it's still temporary. I know another month has passed, they said, but don't worry about it. Stop sending us emails. Stop sending us, text messages that are nasty in nature. Stop making, TikToks about us, because don't worry, it's transitory. Now, by September, the statement was inflation is elevated, largely reflecting transitory factors. So they changed the word risen to elevated, so it rose, of course, during the summer of 2021 and stayed high, elevated. But the key word here remains transitory. It's still temporary. Now, by November, by the way, is not that far away, right? It's 5 months away, 5 months before this period right now, mid-April. They said inflation is elevated, largely reflecting factors that are expected to be transitory. Now they're expressing some uncertainty. They're not sure. And by December, if you look for the northeast of the slide, the statement is utterly transformed. Quote, supply and demand imbalances related to the pandemic and the reopening of the economy have continued to contribute to elevated levels of inflation, close quote. The word transitory is dead, gone, buried. A synonym for transitory is fleeting. This inflation has not been fleeting. It's been persistent. And in fact, recently it's been expanding. We'll talk more about this in the context of construction late during this presentation. Now, a separate statement came out that month, December. Again, that's only 4 months ago now, but a separate statement came out from the Federal Reserve Chairman, Jerome Powell, who said, quote, these problems have been larger and longer lasting than anticipated. Hey, we're surprised. We have been surprised. We thought it was transitory. Exacerbated by waves of the virus, not our fault. This is Delta, this is Omicron, not our fault. Your problem, not our fault. As a result, overall inflation is running well above our 2% longer run goal and will likely continue to do so well into next year, close quote. Well, this is next year. And sure enough, they're right about this one. They might have been wrong about the issue of transitory or not, but they certainly are right that inflation has been worse so far this year. And again, we'll talk more about this in the context of construction later on during the presentation, and then we'll go, of course, as I say, after I finish these prepared or ill-prepared remarks, to Q&A. So again, please feel, almost obligated to ask those questions, because I will leave a fair amount of time for that discussion. Now, as I say, these folks should have known better, because they exert some influence over inflationary outcomes, because they have disproportionate influence over U.S. money supply. Here, graph back to 1959. And you can see how profound the growth in money supply has been during the course of the pandemic. Now, of course, they're working hard to try to slow money supply growth. They're talking about shrinking their balance sheet beginning perhaps next month. But for much of this pandemic, money supply was growing. And of course, that's inflationary. There's an equation in economics called the quantity equation, sometimes also known as the equation of exchange. I like to call it the equation of exchange because that's just downright sexier. And that equation says that when you increase money supply, two things can happen. The economy can grow faster, economic growth accelerates, and or inflation takes off. Prices rise faster. But here's the issue. During much of this pandemic, what's been the problem? Not enough workers, not enough truck drivers, global supply chain issues. You probably have faced shortages of equipment and or materials during the course of this pandemic. You've probably faced a shortage of skilled workers as well. So because of that, those supply side issues, output could only grow so much as they're increasing money supply. So what took on a lot of the burden of equilibrating that equation of exchange? Prices. So the same people who've been telling you it's just transitory are the same people who ensured that it was not transitory, because this is what they did. I'm not trying to criticize, I'm just suggesting that they probably should have had more insight into the nature of inflation than they have had. And now the notion is completely changed. Now the notion is not only is inflation not transitory, but to cure this issue, we have to do something about it. We have to raise interest rates multiple times this year. In fact, the president of the St. Louis Federal Reserve today, a guy named Bullard, said that they want to raise rates massively this year. The market has shrugged it off. The stock market is up today quite significantly, but interest rates appear to be headed higher. The yield on the 10-year Treasury, as I'm speaking to you, is 2.909%. That's that's the highest we've seen during this pandemic. Now, please don't get me wrong. I'm not suggesting to anyone in this audience that the only reason that we've had inflationary pressures is because of monetary policy or the growth in money supply. There have been, for instance, supply chain issues. This is U.S. manufacturers' unfilled orders back to the year 2010. You look at that right side of the slide. By the way, almost all the data I'll show you today are time series data. But if you look toward the right side of the slide, you see that gray vertical strip there. That's the recessionary period of 2020. And it might surprise you to learn that coming into the pandemic, we had an abundance of unfilled orders, but that was not problematic. Why? Because pre-pandemic, the global supply chain was coherent. We didn't have these supply chain issues globally. We didn't have pandemic-era shutdowns. And so the notion was that the supply side of the US economy and the global economy would rise up to meet this demand, these unfilled orders, and would have good growth in 2020, certainly during the first half of that year. Pandemic strikes. We shut down our economy in March of 2020. What happens? Well, many things, of course, but one of the things that happened is that manufacturers like General Motors and Ford shut down their factories. But not only that, they start ordering parts and components like computer chips less aggressively than they had previously. But by May of 2020, the recession is over. The economy is surging back. More data on that in a moment. But the supply side of the economy hasn't been able to keep up with not enough automobiles. And the used car prices have taken off. They're up 35% over the past year because people can't buy new cars to purchase. So now we're back to this period of massive numbers of unfilled orders, but the global supply chain is now incoherent. And it doesn't help that the Chinese have shut down Shanghai or parts thereof and Shenzhen recently. Obviously, it doesn't help that the Russians are assaulting Ukrainian democracy. That doesn't help supply chain issues either, whether with respect to oil, natural gas, platinum, palladium, neon, or nickel. Nickel is an input into steel manufacturing, for instance. So, and we'll talk more about steel later in the presentation, but in any case, the point is that's inflationary when you've got this abundance of unfilled orders, but the supply side can't keep up with it all. Now, even this is not enough to fully explain these inflationary pressures we've been experiencing, the growth in money supply, the supply chain disruptions. The sheer nature of the economic expansion to date has been inflationary. So this is quarterly gross domestic product graph back to the year 1990. The blue color bars are next to the left-hand vertical axis, the red color bars to the right, and you'll notice that the numbers on the right-hand vertical axis are just much bigger in magnitude to accommodate the volatility of the economy, during the course of this pandemic. Now, reading from left to right, the last blue color bar is the fourth quarter of 2019, the last pre-shutdown quarter in American history. It was a quarter of growth. We come into 2020 with momentum. This nation added jobs in January of 2020, added about 400,000 jobs in February of 2020, shuts down the economy in March of 2020, which is embodied by the first quarter of 2020, March of 2020, and that's designated by the first red colored bar here, again, indexed to the right-hand vertical axis. And during the first quarter of 2020, the U.S. economy shrinks 5% on an annualized basis. Well, that's a big deal. So, for instance, during the fourth quarter of 2008, which had been the worst quarter of our economic lives and a very tough period for construction, as it turns out, the U.S. economy shrinks 8.4% on an annualized basis. So, negative 5% print is nothing to scoff at. That's newsworthy. Unfortunately, this time around, it was merely the appetizer for during the second quarter of 2020, the U.S. economy shrinks 31.4% on an annualized basis. That's that red bar that you see slumping to the south of the slide. And around that time, a furious debate breaks out in the economics community. What would the initial phase of recovery look like? Would it be U-shaped, L-shaped, Nike swoosh, checkmark, square root, hockey stick? It was a straight up V. During the third quarter of 2020, the U.S. economy bounces back, growing 33.4% on an annualized basis. That's inflationary, ladies and gentlemen. Why? Because the supply side of the economy at that point certainly can't keep up with that kind of growth in demand. It's trying. Trucking firms are trying to hire more truck drivers, that kind of thing. The Port of Los Angeles is trying to deal with all those ships that are waiting to offload their wares, all that. But the supply side has never really caught up to the demand side, and all of that is quite inflationary. But even all that I've talked about thus far in this first roughly 14 minutes of the presentation are not enough to explain this bout of inflation. There's at least one other thing we need to talk about to more completely explain why we've seen such inflation, and also to provide some insight into how long this will last. And that is the nature of the labor market. Labor market dynamics have played a key role, and in many cases represent the principal challenge to running a construction firm right now in America. And one of the things that we get every month from the Bureau of Labor Statistics are data from the so-called JOLTS survey, the Job Openings and Labor Turnover Survey. The last reading comes from February of 2022, and that suggests that as of February, America was home to 11.3 million available unfilled jobs. That month, we had a bit fewer than 6.3 million unemployed people. So in other words, we had 1.8 job openings for every unemployed person in America. This is the land of opportunity, very much so still. Another way to look at that is that we had 56 unemployed people for every 100 job openings. And one of the reasons that we have so many unfilled jobs, including nearly 400,000 of them in construction, more than 800,000 of them in manufacturing, is because the labor force is not quite as large now as it was pre-pandemic. This is the US labor force participation rate graphed back to 1950. If you look toward the middle of the slide, just as an aside, notice how profound the growth was in labor force participation in the 1960s, 70s, and into the early 1980s, actually through the 80s. That was largely a reflection of women jumping into the labor force in very large numbers, but that pattern peters out with the turn of the millennium. And then for many years after the turn of the millennium, you can see that labor force participation, which is what, by the way, is the percentage of the adult working age population that's either working or looking for work. They're engaged in some way in the labor market, if only just looking for work. Coming into the pandemic period, the labor force participation rate in this country is 63.4%. By the worst of it, you can see that big dip toward the right of the slide, it's 60.2%. That means that the labor force shrank by about 8 million people. Now it's bounced back since that time in absolute terms, but the labor force participation rate is still lower than it was pre-pandemic, 62.4%. And here's one of the things that happened in construction. Some of our best construction workers are baby boomers. Boomers who enter the construction trades because that was their first choice. These are people who often took shop class in high school. Shop class typically taught by someone with enormous arms, wearing a Rush t-shirt and driving a Trans Am. At least that's my recollection. And so these boomers, when they were young people, learned the love of working with equipment, seeing tangible output for their efforts. But of course, shop class in many cases has been removed from curricula. Young people don't have as much exposure to the construction trades, perhaps don't have as much interest in the construction trades for various reasons we can get into. And so we just don't have enough skilled construction workers. Immigration policy probably plays a part in that. Many things play a role in this. But the point is shortages, and that's inflationary. There's something else that's happened. What people want out of work has very much changed over the course of the pandemic itself. So Good Hire is a background check company out of Redwood City, California. They recently conducted a survey of 3,500 Americans. And that survey concluded that 68% of Americans would choose remote work options over in-office work or in-person work. People don't want to commute. They don't want to go to a job site. They don't want to see their colleagues. They don't like their colleagues. A separate survey finds that more than half of Americans find their work colleagues to be annoying. And some of the reasons for them being annoying, they overshare, meaning they just get too personal. They take credit for one another's work, and they interrupt, which, by the way, can happen on a Zoom meeting too, as it turns out. But nonetheless, many people want to work remotely. If you look at the third bullet here, it says 74% of Americans believe that companies not offering remote working arrangements will lose major talent in the workforce. Now, as it turns out, 100% of the people answering that question view themselves as major talent. But again, for industries like retail, or at least brick and mortar retail, traditional retail, restaurants, hotels, construction, manufacturing, where people have to be at the job site to produce goods or services, this makes recruiting that much more challenging. And so when you add in the fact that the labor force has shrunk, labor force participation rate is down, people want different things from work than they wanted before, no surprise, compensation is growing quite swiftly. This is the employment cost index for private sector workers. The dark blue line at the top there is wages and salaries, that increase. The light blue line at the bottom there, that ends at the bottom, is growth in benefit costs. And the red line at the middle, that sandwich, is overall compensation increase. There's a separate measure called average hourly earnings. That's up 5.6% economy-wide over the last year. In construction, the corresponding number is around 6.2%. That's a 40-year high. And here's the thing, many of those construction workers might say to you, look, you gave me a 6% raise, you gave me a 7% raise, and I thank you for that, but by the way, you made me poorer, because inflation is running at 8.5%. So what are they going to ask for more in 2022? Well, they're going to ask for more money. And perhaps you're experiencing that. And so, and that's one of the reasons that this inflation will persist, even as the Federal Reserve tightens monetary policy, even as they shrink their balance sheet, even as they increase interest rates. Inflation will persist because all of a sudden expectations regarding inflation have become untethered. So coming into the pandemic, what was your expectation for inflation? 2%, that's what you thought it was going to be, I suspect. That's what I thought it was going to be. But who thinks it's going to be 2% now? Yeah, exactly. And so people build that into their wage demands, they build it into their menu prices if they run a restaurant, so on and so forth, and so it becomes that much more difficult to constrain inflation. And that's one of the reasons the Federal Reserve will have to work so hard to try to bring inflation out of this economy. And by the way, high interest rates or rising interest rates are generally not good for real estate and construction. More on that later. Now, it's really quite remarkable that we have these labor shortages. And here's one of the reasons why I say that. If you compare February of 2020 employment, why February of 2020? That's the last month before we shut down the economy, versus March of 2022. Why that month? That's the month, last month for which you have data. And of course, we're still in the midst of this pandemic, as it turns out. Though I will be going to the airport in a moment. I'm flying to Omaha, Nebraska tonight via Chicago for Baltimore, and I will not be wearing a mask apparently. Set that aside, please. But the pandemic lingers. And so if you compare those two goalposts, February 2020 versus March of 2022, we're down 1.6 million jobs. So, these horizontal bars represent the number of jobs added or subtracted by each of these categories over time. So leisure and hospitality, which includes your restaurant worker and your hotel worker, is down about 1.5 million jobs. And yet you talk to almost any restaurateur and they will say how difficult it has been for them to staff up fully and maintain regular operating hours. Construction has added 4,000 jobs. But for many contractors with whom I speak, they tell me that these labor shortages are actually even worse than they were pre-pandemic, and they were pretty tough pre-pandemic. The economy was good back then. Now, there have been a couple of segments that have added jobs meaningfully over the course of the pandemic. At the very bottom, the best performer, trade, transportation, and utilities. That, ladies and gentlemen, is your supply chain. That's your trucking firms. That's your Amazon. That's your fulfillment centers, warehouses generally. So, and of course, the supply side has been trying to catch up to the demand side, and that's translated into a lot of hiring. Above that is professional and business services. Has that added more than 700,000 jobs, that segment, because there's so many job openings in professional services relative to other industries, let's say on a per capita basis? No. It's because professional services offers greater opportunity in many instances for people to work remotely. So a lot of the people who are in the labor market right now end up in that category because they want to work from home. They don't want to see their colleagues. They don't want to talk to their colleagues. They can deal with their colleagues on Zoom or go to webinar because you can mute them. But generally speaking, they find them quite annoying. Anyway, now let me show you some other employment data for the nation. This slide has the same setup as that gross domestic product slide. Blue color bars indexed to the left-hand vertical axis, red color bars to the right. If you remember that slide on labor force participation rate, you might have noted that, and I'll go back to it. Let me just go back to it very quickly here. You see that at the very right of this slide, you see that big jump in labor force participation. Americans have been re-entering the labor force in larger numbers recently. And one of the things I hear from contractors is that it's become a bit easier to recruit workers. And why is that? Well, of course, we have vaccinations. We have fewer infections, at least until recently. We have fewer hospitalizations, again, at least until recently. People are chasing higher wages and also inflation. So because we've had this bout of inflation and because rents have been rising and food prices and fuel prices, more Americans are saying we're living from paycheck to paycheck, and that's the kind of thing that will get people off their couches and back into the labor market. And so no surprise, going back to this slide here, we're adding jobs in pretty solid numbers. This is important for the economic outlook. So in March of 2022, since the last bar here, it's again a red colored bar index to the right-hand axis, America adds 431,000 jobs. Pretty impressive. We have lots of job openings, more people re-enter the job market, but you get lots of job creation. And remember, these jobs are being created at relatively higher wages. So folks are making fairly good money, and more people are rejoining the labor force. So if you think about that, that inures to the benefit of spending power. And the consumer is 2/3 of the economy, at least from the perspective of aggregate demand. And so from the outlook perspective, that's pretty benign. Just keep that in mind. We'll talk more fully about the economic outlook later on in the presentation in about 20 minutes, as it turns out. Let me show you some regional data. This employment growth for the 25 largest metropolitan areas in America, February 2020 through March of 2022. So, it's largely a mistitled slide. There are only a handful of metropolitan areas that added meaningfully to their job totals over the course of the pandemic. But at number one, Dallas, Texas. Dallas was booming pre-pandemic, and you could argue it's still doing that. The governor of Texas is a guy named Greg Abbott. Greg Abbott, one of these governors, very aggressive in keeping his state as open as possible for the worst of the pandemic. Riverside is number two. That's in California. Now, the governor of California is a guy named Gavin Newsom, crazily handsome, as it turns out, himself to be a Hollywood actor, which will buy you a slap in the face, as it turns out. But setting that aside, a lot of people move from Los Angeles, which is more expensive or where the unit sizes tend to be smaller, to Riverside, where cost per square foot tends to be lower with respect to apartments or homes. And so we've seen a lot of de-densification of America, meaning people moving from urban centers to suburbs or suburbs to rural areas. And part of that story is remote work. At number three is the Tampa area. That's Governor Ron DeSantis of Florida, elected presidential candidate 2024. Very aggressive in keeping that state's economy open. If you ever meet Ron DeSantis, probably best if you not wear a mask. He doesn't like it. Worst day of the year for him, of course, Halloween. At number four, Atlanta, Georgia. That's Governor Brian Kemp of Georgia, the first governor in the country to reopen his economy. So some governors very focused on keeping their economies open as possible. Other governors, like Governor Andrew Cuomo of New York, or the governor of New Jersey, Connecticut, so on and so forth, were more aggressive. The governor of Massachusetts, Charlie Baker, were more aggressive in keeping their economy shut down. But in any case, that has really affected the economic outcomes. But you might ask me the question, why, Anirban? Why does that make any difference? I mean, after all, the biggest decisions were made back in March and April of 2020. We're now in April of 2022. Why does it still matter? And to explain why it matters, I'm reminded of the parable of Humpty Dumpty. Perhaps you remember this story. Humpty Dumpty was an egg, but an egg with special characteristics: arms, legs, a face. Now, one day, Humpty Dumpty's sitting on a wall, minding his own business, public property, by the way, no trespass. And somebody, probably Vladimir Putin, pushes him off that wall. Now, he's an egg, he breaks. Now, all the king's horses and all the king's men come rushing to put Humpty Dumpty back together again. Now, I'm not sure where the horses were there, they've got no hands, but even the men could not do it. And my point is, the economy is an egg, and it was broken. But it was less broken in some communities, Tampa, Atlanta, than it was, let's say, in a New York, a Boston, Los Angeles. It's been hard to reconstitute that egg, meaning the economy, because of worker shortages, supply chain issues. So areas that suffered fewer business failures, Atlanta, Georgia, fewer employees departing from employment, Tampa, Florida, have been more quickly put back together again. And so you can see some of that reflected on this slide. Now, what does this portend for the future? Now, this next slide, same 25 major metropolitan areas, but now unemployment rates as of February 2022. And what do you see here? Really low rates of unemployment in certain communities. Minneapolis, where the labor force has really shrunk, so they lost a ton of jobs, but still, even with that, their unemployment rate is low. That's really bad news for them. 2.4%. So you might say, well, no, Minneapolis is great, 2.4% unemployment. But the issue is, how are they going to grow their economy when you don't have anybody else left to hire? I mean, who are the 2.4% who are still unemployed? Tampa, 2.9%, Miami, 3%, Phoenix, 3.1%, Atlanta, 3.2%, Orlando, 3.4%. So people are just starting to travel again in large numbers. Orlando's already down to 3.4% rate of unemployment. Who's going to provide the services of the theme parks, hotels, restaurants, etc.? That's inflationary. So, the labor market is still tight, and one of the things that you can expect, I think, on average, for the average construction firm or contractor, is that wage pressure will still be very much in place. And one of the ways to deal with that, one of the ways at least many larger firms deal with this, is buy more equipment or better equipment and better technology to try to raise the productivity of the workers they have on staff. And so necessity is the mother of invention. So we actually see a pickup. We have seen a pickup in equipment purchases by U.S. construction firms and by other firms over the course of this pandemic. Okay, enough of that. Let's get to some of the information which you might have most interest, which is the construction and real estate information. I'll start this part of the story residentially and then move to non-residential construction. Now, we talked about the Federal Reserve early during this presentation. Now we're quite late in this presentation, as it turns out. Their motivations were benign, as it turns out. They didn't want to trigger all this inflation. They did have a hand in doing that. But what was their real goal? Their real goal was, of course, to support the U.S. economy, including with lower interest rates. Here I'll show you two interest rates of interest, the 15-year fixed mortgage rate in red and the 30-year fixed mortgage rate in blue. Note that the mortgage rates, these rates, at least here, have been rising profoundly recently. So coming into this year, the 30-year fixed mortgage rate was close to 3%, about 3.22%. It's now 5%. And that's going to have an impact on the housing market. Now, we are in April. A significant fraction of sales, home sales in a given year are made between March and June of a given year, about 40%. And so you will see that seasonal bump up in buyers being out there, looking at homes and so on and so forth. That's true, but thereafter, once we get through the spring selling season, I think you're going to see some real weakness in the housing sector. Now, look, I'm an economist. I'm in the business of forecasting. I do not like to be surprised. I do not like to admit being surprised on a webinar that's being taped. But I have been surprised, not by the fact that home prices have risen, mind you, but by the fact that they've risen so much through the course of the pandemic that to date has cost us 1.6 million jobs, and to date has shrunk our labor force. But that's exactly what's happened. This is the S&P Case-Shiller U.S. National Home Price Index, and you can see what's happened in the pandemic toward the right of the slide, how profoundly home prices have increased. And many people will say to you, this is a straight-up bubble, they will say. This is 03, 04, 05 all over again. We've seen this story before. It's playing out again. And those people are dead wrong. You remember 03, 04, and 05, what that was about? Well, among other things, it was about faulty or flawed lending. That was your subprime mortgage or no document loan. Look back at the data and see how many Americans missed their first mortgage payment. Not the mortgage, couldn't quite scrape together enough to make their first mortgage payment. It's one of the reasons Lehman Brothers actually faltered in September of 2008. But this time is different. As far as I can tell, lending standards have been quite disciplined. And here's the thing, the inventory of unsold homes is very low, as you know. So this is back to the year 2000. This is vacant housing units for sale. So the homeowner has now moved out of the house and the home is available for sale. Look back in years like 04, 05, and 06, how many homes were available for sale as the lending markets were shutting down because so many people were delinquent on their mortgages. That house of cards had to tumble. Of course, home prices fall, and so do sales. But this is different. You can see that the number of housing units available for sale is actually quite small, quite low. No wonder we've had so many bidding wars over available homes recently. And people say, oh, that must be a bubble. The issue here is we lack enough housing units. Now, one of the things I want to do for you as I move toward the tail end of this presentation is I'm going to show you a number of leading economic indicators, because I want to pivot from showing you historical data to being more forecast or forward-looking oriented. So here's a leading indicator. This is U.S. residential building permits. That's a leading indicator because if you're a builder, you've got to pull a permit before you build. Now, let me talk first about the red segment here. This red segment, again, back to 1995, relates to the construction of single unit structures. That's your townhomes and your single family homes. Look how much we're building back in 03, 04, and 05. We're supplying to that artificially induced demand, that demand induced in many cases by poor lending standards, offering too much credit to people who should not have had access to so much credit, as it turns out. So we have the Great Recession, we have the foreclosure crisis, and then for many years, we don't build much housing. All the while, by the way, our largest generation, the millennials, are coming of age. The most common age in America this year is the age of 30. We have more 30-year-olds than any other age. 5 years ago, the most common age in America was 25. What do 25-year-olds do? Well, lots of nonsense, including weed, but they also rent apartments. And that coincided with the apartment building boom of the previous decade. In 5 years, the most common age in America will be 35. What do 35-year-olds do? Well, some of the same stuff, as it turns out, but they might purchase a home. But we haven't built many homes for them. Now, you might say, well, Anirban, I noticed there's been a bit of a pickup recently in single-family building permits, and you're right, but nothing massive, nothing like 04, 05, 06 in terms of quantity. And why is that? Well, two-word answer, softwood lumber. But it's not just softwood lumber. Lumber gets all the media attention for whatever reason. The lumber prices have risen and fallen, but they remain quite high relative to pre-pandemic levels. But it's also copper, it's concrete slab, it's gypsum, it's glass, it's workers, it's asphalt shingles, it's garage doors, it's anything that goes in the construction of new homes has become more expensive through the pandemic. And that truncates the housing market. How? Because builders find that they can no longer supply to price points that are affordable to their would-be purchasers. Now, the blue segment here refers to multifamily building permits, 2+ units. Mostly apartments, could be condominiums too, and that you can see is raging. And why is that? Well, high home prices have induced many people to stay renters, as it turns out, the lack of inventory and high prices. And now you've got mortgage rates rising, which will make home ownership that much more expensive. So occupancy already has been rising in the US apartment stock. That's pushing rents higher. And that's a signal to the developer community, scarcely, let me build more units. So I think one of the things that you will see going forward is an abundance of multifamily construction. And that would tend to be good for the folks on this call. Now, here's another leading indicator, but this one relates more to commercial construction. This is the Architecture Billings Index. You see the 50-yard line running west across that slide? Any reading above 50 means that architects are busier this month than they were last month. So I know that the last 4 readings to the right look a little weak, but they're not weak. Because what they say is that in February, architects were collectively busier than they were in January of 2022. And in January, they're busier than in December, November, October, so on and so forth. They're busy. Architects come out to me after presentations occasionally and say to me, you know, Anirban, we're as busy now or busier than we were pre-pandemic. Now, why is this a leading indicator? Because the notion is very simply that if architects are busy upstream, contractors are more likely to be busy downstream. Okay, but what if I said to you that the historic relationship between design work upstream and actual construction work downstream has been fractured? That something has changed this relationship. And here's what I mean by this. Historically, there's been a certain relationship between architectural work and the amount of construction that takes place thereafter. But what if I said to you that there was a fair amount of design work, but not all of it or much of it would translate into construction? Let me try to explain this. So some things have changed. So why do we have so much design work in the first place? Private equity firms, hedge funds, others, endowments have so much money to invest, pension funds. They've got to put that money someplace. Now, they could put that money in 10-year treasuries, which are yielding today about 2.9%. Yes, but they're often looking for a higher return than that. And one of the ways to get that return often is to invest in real estate. And when you invest in real estate, that often translates into construction investment. So work is designed, okay, but in some segments, there's some significant weakness. So the economics may not work out ultimately. So for instance, this is the US office vacancy rate. So if you think about gross domestic product, by the second quarter of last year, gross domestic product in our country was greater than it was pre-pandemic. We'd fully recovered along that dimension, but you would not know this from this slide. So that's one of the things that frustrates construction is the fact that we have such an abundance of vacant office space. And that's really misleading, by the way. I'll give you an example of why this is misleading. I leased 2,500 square feet in downtown Baltimore for our firm. 2,500 square feet. It's vacant, but it's not reflected on the slide. Why? Because it's still leased. I tried to get my workers to come back on Tuesdays and Thursdays just to come pay rent. I wanted them to come into the office. They said, and they're mostly millennials, hey, thanks, but no thanks. Thank you very much for the offer. Very generous, no thank you. So the space is vacant. Again, it doesn't show up on this chart because it's still leased. Now, come December 1st of this year, it won't be leased by me, as it turns out I'm downsizing, like many employers. But again, that suggests that as we see more lease renewals, this number could head higher. Here's another thing. During the pandemic, certainly the early stages of the pandemic, we suffered a wave of retail bankruptcies. So among the firms that went bankrupt were Pier 1 Imports, True Religion, Neiman Marcus, J.Crew, JCPenney, GNC, Lord & Taylor, Brooks Brothers, Guitar Center, Francesca's, many others. So no surprise, when you look at vacancy in American malls, it's sky high. And what does that do, all things being equal? It frustrates new shopping center construction. Then you look at hotel occupancy here, back to 2006. The last three bars here are 2019, 2020, and 2021. And admittedly, 2021 was a year of partial recovery for hotel occupancy. But it's still nowhere close to where it was pre-pandemic. So prices get designed, but do the economics ultimately work out? Now, what I notice, however, is the following. The construction levels or construction volume is not necessarily simply a function of economic growth. What it really is a function of economic transformation. And growth is part of that transformation, but it's not the whole story. So one of the things that you're going to see, and you have been seeing, of course, is a lot of adaptive reuse. So shopping centers. Many of them will falter, maybe 1 in 5 over the next few years. US shopping malls will fail. But that's an opportunity for adaptive reuse, economic transformation. So could they be converted into last mile fulfillment centers? Could they be converted into outpatient medical centers, apartment buildings, affordable housing? Yes, in many cases the answer is yes, into some other form of economic activity. So you're going to see a lot of adaptive reuse going forward. And again, that, for people who work with, as wall and ceiling contractors, that should mean good news. But in terms of new construction of office buildings, shopping centers, and hotels, I think that those segments will be weak for the foreseeable future. In fact, if you look here, this is out of the gross domestic product data. This is non-residential fixed investment in structures. This is inflation adjusted, and you don't see any sign of recovery here. So despite all this fulfillment center construction, data center construction, adaptive reuse that we've begun to see, turning hotels into apartment buildings or office buildings into apartments or whatever it happens to be. In some cases, office buildings turn into industrial facilities. You just haven't seen the momentum here. And one of the things I think that's also frustrating new construction, despite all this design work, is the cost of delivering construction services. Here's another inflation measure. This is the Construction Producer Price Index. It's a reflection of how much over the past 12 months have materials prices escalated. And what this says is between March of 2021 and March of 2022, materials prices rose 24.4%, construction materials prices. And so, the project owner, they've done, they've had the architect do design work, the engineers do the design work, and now they put the project out to bid. And they look at the bids and say, I'm sorry, excuse me, what project is this for? Because the numbers in this bid, your bid, don't line up with my pro forma. In fact, if these are the numbers, my pro forma doesn't work anymore, it's busted. And therefore the project is either postponed or canceled altogether. So again, that's one of the reasons I think you see a fair amount of architecture billings, but it hasn't actually translated into massive growth in investment in structures, new structures in particular. Now, I can break down the producer price index data. Again, these are inflation measures. So I can break down this inflation measure for you more finely, more granularly. Same thing, construction materials producer price index data. This is 12-month percentage change, these bars, as of March of 2022. What does it say? The natural gas price up 63% in 12 months. Crude petroleum up 62.2%. Steel mill products, you can see that fourth bar there, up 43%. Iron and steel up 36%. And again, Russia, Ukraine, that doesn't help this. As you know, the Russians are steel producers. It turns out they're also copper producers, platinum, palladium, so on and so forth. So, they have an impact across the commodity spectrum. The Ukrainians are major producers of certain commodities too, like wheat, but many others. Now, you look at concrete, for instance. Concrete typically rises about 3%. It's at the bottom of the slide here, up nearly 10% over the past year. That's significant. And that's the kind of thing, concrete is ubiquitous, that can keep a project from moving forward that otherwise would move forward. Okay, enough of that. I hope you've enjoyed this James Bond theme presentation to this point. Just a few more slides here. My name is Ani Bond, and I promised you some leading economic indicators, so let me bring you a few more. I mentioned a moment ago that the consumer is 2/3 of the economy. What they really are is, as it turns out, 2/3 of aggregate demand. So 2/3 of what we produce in the form of goods and services ends up with the American household or serving the American household. So we care about things like the University of Michigan's Index of Consumer Sentiment. The notion is that if consumers are happy, they're more likely to spend. Where's the consumer right now psychologically? Pretty much in the dumps. April was a bit of a bounce back month for them psychologically, perhaps because the unemployment rate fell to 3.6%, but in March. But the point is pretty miserable. The consumer is saying we're miserable. And number one factor that has them feeling that way, inflation. Inflation is pounding at them. By the way, they're not alone in feeling some sense of trepidation about the near term. This is from the National Federation of Independent Business. This is our index of small business optimism. Question: Small Business America, is it a good time to expand your business? Well, in March, only 6% of small business operators said, yes, it's a good time to expand my business. They face inflation. They can't find enough workers. They can't afford those workers. They can't afford healthcare benefits. They're competing with Amazon and others that are raising their wages for entry-level workers. And so they're in tough shape in many cases. And the issue here is that if small businesses in America are not confident about the future, they won't expand their capacity such that supply catches up to demand. Now, some of these psychological indicators, these confidence indicators, can be pretty misleading. For instance, we don't really care so much about what consumers are thinking, believing, or feeling. What we really care about is what they're doing. And what are they doing? Well, they're shopping. So on the one hand, they say to the consumer confidence surveyor, look, I'm miserable as an American, I am. We've got all these inflationary pressures, our national debt is $30 trillion, we've got all this geopolitical uncertainty facing us. But I can't talk any further with you about these issues. I'm going shopping. This is US manufacturers' new orders for consumer goods. If you look at the slide here, toward the right of the slide, there is no slowdown in consumer spending. Yeah, they're facing inflation. Yes, gasoline prices have risen. Apartment rents have risen, all of that. Right now, the consumer is pretty strong. There's lots of momentum there in that part of the economy. And you really can't have an economic downturn if the consumer is not willing to participate in a downturn. This is from the Philadelphia Federal Reserve. It's based on their Manufacturing Business Outlook survey. And the question here pertains to future delivery times. And if you look toward the right of the slide here, you can see pre-Russia Ukraine. So the Russians began their assault on Ukraine on February 24th. But if you look at the data coming into that period, what were the expectations regarding delivery times? They were falling. The supply chain is getting better. Again, Russia, Ukraine notwithstanding, Shanghai being shut down, Shenzhen being shut down, parts of Europe facing significant Omicron spread, and now Philadelphia and some other American cities also. So that doesn't help the supply side. But again, prior to that recent state of affairs, supply chains were improving. The supply side of the economy was catching up. So you had strong demand, improving supply side, that translates in economic growth. That's one of the reasons that when you look at the Conference Board's index of leading economic indicators, the indicators were suggesting, now this is 10 leading indicators all bundled into one composite leading indicator, which I'm graphing for you here back to the year 2000, but the index has been saying lately, growth. America is poised for growth. And I think that's right. And that takes me to my final slide of this presentation. You only forecast twice. So as I say in that first bullet, this will be a year of growth, but watch out for 2023. That could be very different. So as I said, 2022, the economy is still coming out of the pandemic. Consumers have lots of pent-up demand for travel and other things, family get-togethers, that kind of thing. That drives economic activity. The businesses are still investing in equipment because they can't find enough workers, that kind of thing. State local governments, in many cases, are flush with cash. So, and of course, we had an infrastructure package signed by the current president on November 15th of last year. So, but 2023 could be very different because what's also happening right now, I think that this bump in activity coming out of the pandemic will soften. Right? So that pent-up demand will be satisfied and no longer released to the market in the form of pent-up demand. And interest rates are going to jump this year. Since the early 1980s, the Federal Reserve has engaged in 8 rate tightening cycles. They're in the cycle now, 8 rate tightening cycles since the early 1980s. 6 have ended in recession. Even the Baltimore Orioles have a better record, as it turns out. So I think 2023 is fraught with risk. The economy, on top of that, will remain unbalanced, with supply struggling to keep up with demand. Supply side is getting better, but again, now you've got Ukraine, Russia, and Omicron, China, Europe, elsewhere, and that hampers the supply side of the economy's recovery. Along with rising wages, amidst the Great Resignation, that unbalanced economy translates into higher than average economic inflation in 2022. And you'll hear a lot of talk this year about stagflation. Stagflation. The combination of slow economic growth and lots of inflation, which is, by the way, what the first quarter was. We don't yet have the GDP data for the first quarter of 2022, even though we're now in April. We'll get that in about 10 days, actually about a week as it turns out now. But when that comes out, it'll show maybe 1 to 2% growth, but lots of inflation. That's stagflation. I think the next couple of quarters will be pretty decent as we come out of this and supply side continues to improve. Again, Russia, Ukraine notwithstanding, but watch out again for 2023. And then finally, yes, I'm an economist, so I'm forecasting interest rates to increase. You ask economists almost anywhere, movie theater, mall, dry cleaners, ballpark, arena. Hey, are interest rates going to rise? We will say yes, and we've been doing that for 40 years. Most of the time we're wrong, by the way. It doesn't stop us from saying it. But this time we know the Federal Reserve is behind the curve. They started way too late. They're going to raise interest rates, and at some point, that's going to hit the U.S. construction sector. Not now, as I say, multifamily red hot, data centers, fulfillment centers, so on and so forth, backbones of the economy, lots of economic transformation coming out of the pandemic. But at some point, the cost of capital is going to drown out some of those positives. And what does that mean for construction in 2024, 2025? Well, perhaps one day we'll talk about that. But the outlook for those periods may not be quite as strong as what we're observing right now. And so if you enjoy this kind of information, I have a newsletter at basu.substack.com. There's a free service here, so I'm not necessarily dialing for dollars. If you're not interested, of course, please feel free to pound sand. In any case, let's go to Q&A. It's been a privilege to be with you today. What I want to do is I want to stop sharing, if I can figure out how to do that. And let's go to Q&A.
Okay, we have one question. A lot of feedback first came in through the depth of the information that you shared in this amount of time. So a lot of kudos along to that. And one question, attendee had to step away for a few minutes, so apologized if you already briefly mentioned this. As he noted, work doesn't stop. But his question was, it always seems that when inflation goes up, the Federal Reserve raises interest rates. That makes money more expensive. Why doesn't that also increase inflation?
Right. So as it turns out, it's a very insightful question. So when the first order impact, of course, of increasing interest rates is to actually make life more expensive. Because, for instance, owning a home, if you're a purchaser buying a home at higher mortgage rates, owning a home is more expensive. That's inflationary. If owning a home becomes more expensive, then more people will opt to rent. That drives apartment rents. But here's the thing. By and large, the effect of rising interest rates is to curtail economic activity. Fewer people are investing money because they can just sit around and invest in bonds and get some kind of yield. So, a few months ago, the yield on the 10-year Treasury was 0.8%. So if I want to make any kind of return, I've got to invest my money in some part of the economy. But if if that 10-year Treasury bond is now yielding 2.9%, I might decide to curtail some of my investment and just have it sitting in Treasury bonds. And so that generates less economic activity. So the notion is that they're going to try to engineer a soft landing. They're going to cool the economy. By cooling the economy, they slow job growth. They slow these inflationary pressures. And the question becomes, do they soften the economy so much that they drive it into recession? That's a very good question. But by and large, between the first and second order impacts, the impact of rising interest rates tends to be to moderate inflation. That was certainly the effort of Alan Greenspan in the 1990s. That was the effort of other Federal Reserve chair people in our history. And now we have the current Federal Reserve Chairman, Jerome Powell, is trying to do the same thing. And as I said, the Federal Reserve has a very poor record of engineering soft landings. That's one of the reasons that I'm so worried about 2023 economically.
Very good. Thank you. That was the only question we had. So no others are coming in, but on behalf of AWCI and the Foundation of the Wall and Ceiling Industry, I would like to thank Dr. Basu and all of our attendees for joining us for today's webinar. And Dr. Basu, we appreciate you sharing your economic insight in the energy, especially that you brought to today's presentation. So thank you kindly.
Thank you. I've been told I'm a bit of a spaz, so that's the way it shows up on the screen, I'm sure. But hey, thanks again to AWCI for inviting me. I hope we meet again, maybe in person next time, and we can talk more about these issues, including what 2024 and 2025 might mean for the U.S. construction industry. Until then, hey, good luck to everybody.
Thank you so much. Have a wonderful day. Bye-bye.